Okay, so in today's video, I'm going to be sharing with you a strategy that you can use if you have a small account. And by small account, what I mean is that if you have an account size of $5,000, maybe $3,000, or even $1,000. So what is this strategy that you can put on if you have a very small account? Well, that strategy is what's called the debit spread. So the debit spread, unlike the credit spread, you actually have to pay upfront for it. So debit spreads have two types, right? You have the bullish debit spread. So the bullish debit spread is also what's called the bull call spread. So how you construct the bull call spread is generally you buy one call option, usually around at the money. So as you can see, this is the line down here that's denoting where it's at the money. All right, so anything that is above this line, this is considered in the money, and anything that's below is considered out of the money for the call side. So I generally like to construct it somewhere around at the money, so it can be somewhere around here, and then you can construct it just 5 points wide out. So over here, you can see that this is the construct for the bull call spread. And the max loss, as you can see, is not that much. It's only about $300. Your max profit is about $205. So you can see that if you have a very small account, you can definitely put on the bull call spread. Now, the other debit spread is the bearish debit spread. So the bearish debit spread is what's called the bear put spread. So the bear put spread, similarly, what you're going to do is you're going to buy one put option and it's going to be always somewhere around at the money as well. And then similarly, you can go 5 points out. And as you can see over here, the max loss down here is only $161 and the max profit is around $339. So why do I say the debit spread is going to be suitable for those who have very small accounts, especially if your account size is only about $3,000 or maybe even $1,000? And the reason is because generally, if you were to trade the credit spreads, the premium strategies, you notice that the risk tends to be slightly bigger. All right, so in this case, you can see that, the max loss is about 161. You can construct about a 5-point wide spread. But if we were to go for let's say the put credit spread, a bullish strategy. So the put credit spread, usually we want it to be somewhere around 30 to around 20 delta, somewhere in between around there, right? Especially if you do not want that low of a win rate. So if I was to go, let's use the 20 delta one. If I was to construct the put credit spread using the 20 delta. So if I choose 610, I'm selling this put option and I'm buying the put option that's 5 points away. You can see over here, your max loss is actually much bigger. The max loss is about 443 and your max profit is not that much. So this is one of the characteristics of a put credit spread. Generally, the risk tends to be slightly bigger than if you were to put on the debit spread. Now you can say that, hey Davis, for the put credit spread, I can actually make it 1 point wide. If I make it 1 point wide, you can see that the risk is so much smaller. And the answer is yes, you can. However, I don't really like this kind of construct because this construct tends to be much riskier compared to this if you actually put in the same risk per trade. That means you risk the same amount. So for example, if I was to compare this one, the risk is 443, and I compare this, and I want to make this to 443, what I would do for this is I would have to increase the contract size. So if I increase the contract size to the point whereby the max loss is similar, then you'll notice that this is going to be much more riskier than the one at 605. Why is that so? Because it takes lesser of a move down for you to go past the long leg, which is where you generally get into a much bigger loss. So that is why generally with a put credit spread, I do not like to go for very tight spreads. And if you were to take a look at some of the studies done by the Tasty Trade team, you also see that they don't really favor very tight spreads as well. It tends to be a little bit more inconsistent. So generally, I like to go somewhere at least 5 points wide if you want to construct a decent spread width for the credit spread. So similarly for the debit spread, I also want somewhere around 5 points wide. So if I was to construct the 5 points wide, you'll notice that you're going to have much lower risk compared to the put credit spread. Now, if that's the case, you might be wondering, Davis, then why don't I just fully trade the debit spread? Now, first of all, the answer is yes, you can actually fully trade the debit spread if you do not mind just trading the debit spreads alone. But the thing that you need to realize is that there is just a trade-off. So the trade-off with debit spreads versus credit spreads is that debit spreads, they tend to have lower win rates compared to the credit spread, because usually for the credit spreads, you're constructing it out of the money, Whereas for debit spreads, we're usually constructing it at the money. So if you construct one that's at the money, let's say, for example, I choose 635 and 640, you will see that the win rate is not as high as the credit spread. As you can see over here, the pop is only about 47%. Now, some people like to go out of the money. Now, out of the money just means that you're shifting the whole thing further out of the money. And this is one of the things where a lot of beginners tend to do, they like to do, is because you can see over here, the max loss is much lesser and you can get a better risk to reward because your max profit is going to be much more than your max loss. However, I don't really like this strategy, mainly because you can see the pop is very low. So yes, your risk to reward is going to be higher than at the money, but your win rate is going to be very low. And a lot of people, they just cannot handle this win rate because psychologically, we all want to win. And if you have a win rate that's 28%, that means you're going to have a very long losing streak. And if you were to see some of the videos that I've shared previously where I show you the losing streak table, you can see that the number of losses in a row based on the 28% is going to be very long. So that means you can have like 5 to 7 to maybe possibly even 8, 9 or 10 losses in a row. And not many people can actually handle that. So while the risk to reward is actually, much better than at the money, this is where a lot of people is going to struggle trading the debit spread. So that is why I would suggest just go at the money and you're going to have a pretty decent risk to reward, at least better than if you were to trade the credit spreads. Now, the next thing that you might notice, let me just shift my face over here, is that when you are doing the put debit spread, the risk reward is actually better. So you can see this is 5 points wide. I just do it at the money. And the max loss is 295, the max profit is 205. So the max loss is slightly bigger than the max profit. But if I was to construct the put debit spread side, and I was to go about 5 points wide as well, you notice that the max loss over here is much lesser than the max profit. In fact, the profit is about 2 times more than the max loss. So why is that so? Well, the answer is because of what's called the put skew. So when you have a put skew, you generally have this effect over here. Now, if you have a call skew, the call skew is basically the opposite. That means you're going to see this kind of risk to reward, but for the call debit spread. And then the put debit spread is going to be worse, right? So it's going to be similar to what we see on the call debit spread here. So usually for the index ETF, so this is on SPY, you will find that there's going to be a put skew. So that means to say, if you put on the put debit spread, you're going to generally have a much better risk to reward compared to if you put on the bull call spread. But that is not to say that you shouldn't put on the bull call spread, because remember, this is SPY. So SPY generally is what's called a positive drift vehicle. That means in the long term, it wants to go up. So generally, the bull call spread will tend to have a better win rate over the long term compared to the similar put debit spread where you're basically constructing it at the money. Now, the second reason and the more important reason why I say this debit spreads is good for a small account is because it has been proven to be net profitable. So this is the most important thing. And when I say net profitable, it can be net profitable provided you put it on the right underlying. So for this, we're going to be focusing on the bull call spread, and we're going to be talking about SPY, because SPY, as you know, like I mentioned, is a positive drift vehicle, and the bull call spread is a bullish strategy. It makes money as the market goes up. So let us take a look at some statistics for this. So for this, the Tasty Trade team actually already has a statistic that have been done on the debit spreads to show you that it is net profitable over the long term. So this is very important. Any strategy you plan to trade, at least take a look at some statistics and even do some backtesting of your own if you can, to give you an indication that the strategy can actually do well over the long term before you start trading it. So definitely do not just hear somebody saying that, hey, they made a lot of money, just put it on. But rather, let's take a look at some objective studies. So over here, you can see that the study down here is done on the SPY 2005 to present. So I think this study is until around 2017, and it's based off the 45 DTE options. So as for the debit spread, how they constructed it is that they bought the long 60 delta, right, for both the put and the calls, and then they short the 40 deltas for the put and the call. So if I was to go back to the option chain, you will see that the 60 delta is actually much more deeper in the money, right? It's basically this, and then the one at 40 delta is somewhere around here. So the Tasty Trade team, what they do with this test is that they construct one whereby the at the money is somewhere in between these two strikes, right? So for this, you actually have a slightly higher win rate than the one I constructed earlier just now. So if you will take a look at the win rate, you can see the pop is about 50%. Whereas the one which I just shared earlier, which is somewhere around here, this one is about 47%. So it's slightly off. So you can actually construct the long leg to be in the money if you want to, but it's not too necessary. In this case, I think somewhere around at the money, that's fine as well. And I'm going to show you also the results for this one later on. So first, let's get into the studies. So what they did is that they compared the management. So there is one where they exit at 50%, and the other one they just hold all the way to expiration just for the max profit. So let's take a look at the results. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So you can see that they did the test for both the put spread as well as the call spread, and at the end of the day, after all the results are out, the put spread is negative, right? Take a look at the average P&L over here. So the average P&L just tells us over this study whether is it net positive or is it a net loss. So the average P&L, you can see down here for the put spread, it is in a negative, and it makes sense as well because SPY generally is a positive drift vehicle. It just kept going up. So obviously in the long term, the long put spread is not going to be profitable. So this is one strategy for the put spread. You do not want to always keep putting on, right? So how the study is done is that they put on the trade once it reached the criteria of either expiration or 50% take profit. The trade is being closed and they open a new one again. So there's always a trade that replaces the closed trade. So it's always considered in the market. So it's considered somewhat perpetual in a sense. So this shows you that you do not want to have a perpetual long put spread because the market is going to go up over the long term. You're going to be overall a loss. Now, what we're going to look at is the long call spread. So I have it highlighted here in the green box. So let's take a look at the win rate. So the win rate, you can see, is actually higher than what the theory actually suggests. So over here, the theory suggests even the 60 delta one. Over here, let me just move it over here, my face. You can see that the pop is about 50%. That's the win rate. So why is it that the theory suggests is 50%, but then when they did the study, it actually shows a much higher win rate? And the answer is because during the period that has been tested, it has been mostly bullish for the most part. So in a very bullish environment, you're going to have a higher win rate compared to what the theory suggests. So naturally, if it's going to be in a bull market, which is what the S&P 500 generally is in most of the time the market just goes up. It's in a bull market, you're going to have a higher win rate. So the important keynote to see down here is the average P&L. That means you are going to be in a net profit over the long term, right? You can see the average P&L per day as well is going to be positive. Although if you exit at 50%, it's going to be much higher. So in terms of being efficient of the capital and trying to get the best bang for your buck, exiting at 50% seems to be the better one, at least based on the average P&L per day. So this study, what is important to note is that there is no timing of the market whatsoever. That means they didn't say, all right, I'll take a look at the stochastics. If it's oversold, then I put it on, or they look at technical analysis or maybe support and resistance. They did none of that. This is a pure statistical study of just putting on the trade over and over again, regardless of what's happening in the market. That can be, economic news, that can be crash, that can be the tariffs, whatever. They're just putting on the trade. So that doesn't mean that you have to trade it this way. The study is just based on it. What it just means is that if you see that the study shows that regardless of the market condition, they're just putting on the trade over and over again, and in the end it's net profitable, it just means that if you apply your own way of entering the market, let's say you want to time the market, whether is it based on indicators or technical analysis, at least you know that you have a better chance of succeeding compared to if you put on a strategy where it does not show you a positive result. So that is why I say seeing the statistics, the study is very important for us before you put on any trades. Now, next, what I want to take a look at is the individual trades. So you kind of know what to expect as well. So although it's going to be positive over the long term, there are certain things that you do want to really take note of when you're trading debit spreads. So for this, let's head on over to the backtesting tool on Tasty Trade. Okay, so this is the back testing tool on Tasty Trade. So if you have it as well, all you got to do is for this, we're going to choose the debit call spread. And for the symbol, we're going to choose SPY. And for the interval, we're going to choose the past 5 years. So the study which I shared with you earlier on was from 2005 to around 2017. So for the most part of that period, except for during the financial crisis around 2008, for the most part, the rest of the periods was pretty much bullish periods in a sense. But what about over the past 5 years? Over the past 5 years, we have the pandemic, and then we also have 2022 where it was a bear market. So how did the debit call spread actually perform over those times, over this past 5 years? So let us examine, let us take a look. So for this, I'm going to change the delta for this. So what I've used earlier on the option chain was a 50 delta one, and then we can just go for somewhere around 40 deltas. So for the expiration date, we can go for around 45 DTE because according to the Tasty Trade studies, they also use 45 DTEs as well. Now for this, the entry condition is going to be every day, but we're going to limit it to just one active trade. That means to say we are only going to have one trade on at any single time, which pretty much is going to simulate how you are going to actually trade the strategy as well. So once the trade is closed, you're going to put on a new one again. So in this case, the study is just based off of a perpetual way of trading the bull call spread. So you can see that this option is chosen, don't enter a new trade. So we're always going to have one trade. And then next, we're going to leave all this off. And for the take profit, we're going to use 50% because according to the Tasty Trade studies, that's where they get the best average P&L per day. So we're going to use this as well. Everything else, we're going to switch it off. So based on this, we're going to just hit the run back test and take a look and see how it actually performs over the past 5 years. Okay, so as you can see, the results are out and it is a net profit at the end of the day. And even though there has been the 2022, right, overall, it's still going to be a net profit. So that is the good news about this strategy. And if you were to compare the results, if you were to buy and hold, you can see that the return is going to be much higher as well. If you were to buy and hold based on this, the return is roughly around 94.72%. But if you were to do it on the bull call spread, you can see that it is much higher, and it makes sense as well because again, when you're using options, it is a leverage position. So with a leverage position, you're generally going to enhance the performance of the underlying, but at the same time, it's very important to note, your drawdown is also enhanced. So based on buy and hold, your drawdown is about 25%. But if you were to put it on a bull call spread, you can see that the max drawdown is about 80%. So this is very important to note, which is why money management is very important. This is the reason also why you do not want to put all your money into just one single trade, because if you actually hit a loss for the trade, then it's going to be a very big loss. Okay, so let us look into more details to understand the strategy a little bit better. So let's look into details. So over here, you will see that the win rate is actually pretty decent, right? It's about 70%. It's not as high as a put credit spread, right, which is a bullish strategy. So with the put credit spread, you generally have a higher win rate. So next, let us take a look at the average BPR per trade. So actually, the average buying power is pretty manageable. It's only about $300. So if you have a small account, then you can definitely put on the trade like this. And there are more details as well. You can see that the average profit loss per trade is about $36. And this is the other statistics that you can look at as well, right? Some people like to look at the CAGR, right? You can look at this as well. Now let us dig into this a little bit further and let us take a look at the trade log itself. So we can see on a trade to trade basis how the trade is actually being constructed. So these are the trades. You can see how it took profit, right? If it expired, what is the loss, and so on. So let's take a look at the orders. So for the orders, you can see that how they constructed the trade is roughly around 5 points wide for the most part, which is in line with what I've shared with you earlier on when I constructed it on the option chain. So when you construct it around 5 points wide, right, this is also 5 points wide, you can see that over the long term, you can be net profitable. Now, one more thing I want to do before I end this video is I actually want to test it if it's actually held all the way to expiration. And let's just see how is the results compared to if I was to exit at 50% take profit. So I'm going to hit the run back test button and let us take a look at the results. Okay, so the results are out if you hold all the way to expiration. And as you can see, it doesn't actually look that promising. The return, although it's a positive, it's only about 49%, which pales in comparison to if you were to exit at 50% take profit. So that is why the TC Trade team also, they did their studies. And what they found is that the average P&L per day based on 50% actually is much, much more than if you hold to expiration. So if you are to trade the bull call spread as well, then you definitely do not want to hold all the way to expiration, because it seems that you're going to have a lower return and even you're going to get a higher drawdown. So this is where doing the studies and seeing these statistics is very important, because sometimes we might think that holding to expiration might be better because we get the full profit when you hold to expiration compared to 50% take profit. Some people will rationalize that way. They might say that, hey, if I hold to expiration, I get the full profit for that. Why do I want to take profit at 50%? It just doesn't make sense to me. Well, this is why we must always see the study and the statistics. So the statistics will tell us very objectively which is going to be better over the long term. And over here, clearly based on the statistics done by the backtesting tool and also by the studies done by the TC Trade team, we can conclude that if we were to trade the call spread, the bull call spread, it will give us an overall better performance if we take profit at 50%. Alright, so hopefully this video has been helpful for you, and if it has, I would greatly appreciate if you give me a thumbs up on this video and also subscribe to this channel for more options trading videos like this, and I will see you in the next one.